the 1929 crash, the day the Roaring Twenties died. Introduction. The Wall Street crash of 1929, also known as the Great Crash, was a pivotal event in global economic history. It marked the dramatic end of the Roaring Twenties and the beginning of the Great Depression, a period of worldwide economic hardship that lasted more than a decade. The crash wasn't just a financial disaster. It was a psychological blow to a society intoxicated by wealth, progress, and the illusion that prosperity would never end. The Roaring Twenties. Setting the stage, the 1920s in the United States were a time of great optimism. The First World War was over, jazz filled the air, consumer goods were booming, and Wall Street was riding high. Millions of Americans began investing in the stock market, many for the first time. There was a widespread belief that the market could only go up, a dangerous misconception. Key factors that fueled the boom: mass production and the rise of industries such as automobiles, especially Henry Ford's assembly line. Easy credit and installment buying. Speculation in real estate and stocks. Lack of regulation in banking and finance. A cultural shift toward individual wealth and investment. What caused the crash? While the crash of 1929 appeared sudden, it was the result of deep structural weaknesses in the U.S. economy and financial system. Here are the core causes. 1. Overspeculation. Investors were buying stocks on margin, borrowing money to invest, creating inflated asset prices. A stock that was worth $50 could be bought with just $5 in actual cash, with the rest covered by borrowed money. 2. Lack of regulation. There were few rules on how stocks could be bought and sold. Insider trading was rampant, and banks were investing depositors' money into risky ventures. 3. Uneven distribution of wealth. Most of the wealth was concentrated in the hands of a few. While industrial production soared, wages for workers remained low, reducing real purchasing power. 4. Agricultural recession. While cities thrived, farmers struggled. Agricultural prices had been falling throughout the 1920s due to overproduction and falling global demand. 5. Decline in international trade. The global economy was still recovering from WWI. Protectionist policies like the Ford-Macumber tariff made it harder for Europe to export goods to the U.S., reducing their ability to repay debts. The crash. October 1929, Black Thursday. The first signs of trouble appeared when the market fell sharply. Panic began, but major bankers tried to calm the public by buying large amounts of stock. Black Monday. Confidence collapsed again. The Dow Jones Industrial Average dropped by 13%, the largest one-day percentage drop at that time. Black Tuesday. The worst day in Wall Street history. Around 16 million shares were traded in a frenzy, and billions of dollars were wiped out in hours. People lost their life savings. There were suicides on Wall Street. The bubble had burst. The aftermath. Great Depression. The crash was not just a financial crisis. It was the beginning of a worldwide economic depression that lasted until the early 1940s. Economic consequences. Bank failures. Over 9,000 banks collapsed in the U.S. during the 1930s. Unemployment at its peak. Unemployment in the U.S. reached 25%. Global impact. The depression spread to Europe, Asia, and Latin America, with international trade falling by nearly 70%. Homelessness and hunger. Shantytowns called Hoovervilles sprang up. Soup kitchens became a necessity for many. Political and social reactions. The crash shook faith in capitalism and led to a re-evaluation of the role of government. In the U.S., President Herbert Hoover was criticized for his passive response. In 1933, Franklin D. Roosevelt was elected and launched the New Deal, a series of government programs aimed at economic recovery, regulation, and social safety. Worldwide. The crisis contributed to the rise of totalitarian regimes in Europe, including Nazism in Germany and fascism in Italy. Britain, France, and other nations adopted protectionist measures, making recovery slower. Lessons learned. The crash of 1929 taught economists and governments critical lessons about the dangers of unregulated capitalism and speculative bubbles. Key takeaways. Regulation matters. Institutions like the SEC were established to oversee markets. The economy needs safety nets. Programs like Social Security were introduced to help prevent extreme poverty. Confidence is fragile. Market psychology can quickly shift from euphoria to panic. Legacy. Today, the 1929 crash remains a cautionary tale. Though markets have crashed since, none have had quite the same long-term global devastation. The Great Crash remains the ultimate symbol of financial hubris, reminding us that what goes up can, and sometimes does, come crashing down. Final thought. The 1929 crash wasn't just a collapse of stocks. It was a collapse of dreams, of trust, and of the belief that prosperity was eternal. But it was also a turning point that reshaped modern economic thinking and paved the way for a more balanced and compassionate approach to capitalism.